All right, while we're getting set up here, why don't I get started? We are the first panel, a collection of bottom 99 percenters to talk about taxing via mark-to-market or other approaches. I am honored to chair a panel. I knew this was going to be a good panel, but my estimation of it went up several times after we had a 1-hour phone call and then a protracted email exchange after that, trying to set up even what we were talking about. So Jane Gravel is a senior specialist in economic policy at Congressional Research Service. Carl Russo in the middle, or two over from me, is director of the National Economics and Statistics practice at Pricewaterhouse Coopers. Eric Toder, on my far left, is the co-director of the Tax Policy Center and an Institute Fellow at the Urban Institute. So let me just start the conversation off at ground one, at the very beginning. And Jane, let me ask you to get us all on the same page and explain what's a capital gain, how are capital gains taxed now, what are the problems with that, and then tick off the alternatives that we could consider.
Okay. Well, capital gains are appreciation in assets, like the stock market is one of the most important, but also assets held in private companies and real assets, such as real estate. So they're just increases in the value of that. If you sell them, you're subject to tax, but that tax is at a lower rate than ordinary rate. So the top rate on capital gains is a 20% income tax plus a 3.8% net investment tax, so it's 23.8%, whereas the top ordinary rate is 37%. There's a schedule of taxation and so forth. Unrealized gains are not taxed at all, and if you hold on to them and then pass them at death, there's called a step up in basis, so you increase the basis of the asset that basically wipes out any taxation of that gain ever occurring when the heirs sell the assets. So there's a huge swath of income from capital gains that is never taxed as a combination of our realizations principle. It's also taxed at a lower rate, and it's also exempt when it's passed on at death. And on top of that, any revenue realized from any capital gains increase, at least by the scorekeeping by the Joint Tax Committee, could be very small because there's an assumption that people will reduce the amount they realize if you increase the tax. So it all makes capital gains, which is probably the main income of very high income people, such as the three people that the Congresswoman mentioned. That's probably their major earnings, and it's probably unrealized gains in Microsoft stock or whatever. Let's see, so those are the problems. We're missing a lot of revenue, and I actually think this is one of the few ways, the idea of mark-to-market is one of the few ways you can actually tax income of very wealthy individuals. Otherwise, you just can't get at it. So I outline in the paper, I think that's been handed out, as sort of one method of what we could do with unrealized capital gains, which is to mark publicly traded assets to market and tax them every year. So if your stock went up, you would tax, even if you didn't sell that stock, you would tax the appreciation. For assets that are not publicly traded and hard to value, there's a very simple look-back method you could do to increase the taxation of that gain to account for the deferral of the tax over the period. And then I think at the time of the inheritance or estate tax time, you would treat the estate tax as a taxable event. Now you might have a liquidity problem in that case, and you could probably allow a payment schedule with interest. I mean, there's lots of ways to deal with liquidity in the estate tax. The alternatives are to trying to tax income of the wealthy. Of course, one obviously alternative is to raise the corporate income tax, which is mostly helped by high-income people, pension funds, and actually foreigners. You could do a lot of little things like eliminate the pass-through deduction for unincorporated business for high incomes. You could tax carried interest as ordinary income. You could apply the net investment income to income of active income of subchapter S. And now I understand you could also make some money from applying it to some limited partners. You could increase the estate tax although there's kind of limited revenue there in the estate tax. So I think those are sort of I may have missed one or two there, Bill, but I think that's most of them.
All right, great, thank you. Eric, you and Alan Bayard proposed the mark-to-market system a few years ago, or mark-to-market as part of a system of reform. Tell us, how would mark-to-market actually work?
Okay, so we were only going to apply mark-to-market to publicly traded assets. Our feeling was it could not be done for private businesses where you did not have a good valuation, and that's one of the big problems that we'll talk about a little more in this conversation. But the way it would have worked was, suppose you have stocks, your broker will tell you at the beginning of the year how much it's worth, at the end of the year how much it's worth. We actually wanted to use an average for the month of December to avoid weird things that might happen in one day. You would calculate that difference and you would report that as ordinary income on your tax return. We would also allow, if you had a loss, for you to deduct that loss. Under current law, you can't deduct the loss on capital gains losses. You can only deduct them in a very limited way from other income. You could deduct them against other gains, but not other income. And the reason we have that limitation under current law is that, as Jane pointed out, the realizations of capital gains is somewhat voluntary. You don't have to, and you can pick and choose. So you don't want to have a situation where people who have a lot of gains on some assets and losses on others take their losses and take a big deduction, even though they might have had net positive income. We wouldn't have that problem under our system because capital gains would be taxable whether you realize them or not. So we've taken away so you can allow losses. I don't want to go into all the details. Maybe we can a little bit later, but there are a whole lot of problems that this system arose in our paper. We had various solutions for these problems, whether they be volatility or lack of liquidity and so forth. So we can go into that later.
Okay. All right. So in terms of the problems, obviously one big one is how to deal with non-marketable assets, privately held companies. Let's set that aside for a second. We'll come back to that. And Carl, talk to us about what are the problems, what are the issues that arise in taxing market valued assets?
All right, and I should start off by saying that any views that I express are my own and not necessarily those of PricewaterhouseCoopers or any of our clients. It's very similar to the disclosure I used to have to give when I was at the Joint Committee on Taxation, where I was for almost more than a decade, when we thought a lot about these issues and helping members of Congress like Representative Schakowsky work on various proposals in this area. So when you're thinking about taxing appreciation, it's something that would be in an income tax system that most economists would design, right? An income tax is going to tax you on your consumption plus your changes in wealth, and so it's an important component of that. But the question is, how do you measure that? And one of the ways in which people have tried to address that is to limit the proposal to assets for which there is, a clear indication of value delivered by the market. The problem with doing that only for marketable securities is that if you exempt any class of assets from a mark-to-market regime, you create a strong incentive for people to switch their wealth holdings into those assets that are exempt from the system. And you could do that even very simply, right? You could have a corporation which you own all of the stock of, in which you stick all of your marketable securities. The stock of the company that you own, Carl Russo Corp, is not publicly traded. Are you going to look through it to see the value of the IBM stock and the Amazon stock that's in there in order to tax me on the gains? And of course, if you were to try to start writing rules around those issues, you're chasing the potential compliance issues as you go. So in the effort to do the marketable securities as a way of getting around the most fundamental issues, which is what is the base of the tax? What's the valuation issue? It's severable from the question of the timing question, the realization principle. And if you have, as Jane was discussing, methods to try to deal with some of those other non-tradable securities where you're going to have to look back, and try to impose some charge in order to get somebody in the same place that you would be in, you end up having a lot of complexity because you need a different rate of interest for every asset in order to get you in the same place that you would be if you were just taxing marketable securities on a year-by-year basis. And a lot of members have sort of shied away from those complexities because they're non-trivial to try to address.
Okay, so I'll throw this out to the panel. What if you do mark to market for marketable assets? What do you do for non-marketable assets? Do you do a look back? Do you?
Well, I can say, I think this, first let me say I don't represent the views of the Congressional Research Service. I forgot to say that, I'm supposed to. I have in my paper, for your ordinary asset without any complexities, I mean, Carl has talked to us about depreciation and things like that you deal with. It's a very simple formula. All you need is the sales price, the basis, the time holding period, and the current tax rate. And from that, you can create, well, to me, it's a very simple formula. Perhaps to some people, it looks a little complex, but you ought to be able, rich people whom we're probably going to apply this to ought to be able to hire somebody to do that kind of simple math. They could, for example, hire me.
And the point is that the information is very easy to get.
Very simple information.
Personally, yes.
This is all of the things that you already know from the tax return, because you would know this when you were taxing the gain anyway. Then all you do is you set up a formula that says, I'm going to increase the amount of gain I realize or decrease my basis by just enough to yield me the same after-tax return that I would have gotten had I paid taxes all along. And it's a simple way to do it. You're going to have complications if you have depreciation and improvements in property and things like that. I've been doing a lot of thinking since our conversation a couple of days ago about that, but I think all those problems are solvable. So, but I do think you have to, I think the look-back method is much easier than trying to apply a generic interest charge every year because you implicitly are charging interest at the growth rate of the asset.
So you would be charging taxes as wealth accrues for marketable assets and as it's realized for non-marketable assets, but the tax when it's realized would be adjusted so that the equivalent tax on accrual would have occurred.
You should get rid of the incentive there to not realize capital gains, which is a very important part because then you can talk about raising the tax rate without incurring this realizations response, and then you have the possibility of really taxing this income effectively.
Yeah, just a few comments about this because we thought about that a lot, and it is easy to develop a formula and to develop a formula that's understandable. The question is whether the formula is right, and if the formula is wrong, what right meaning that it gives you the same result that you would if you tax the accrued gains every year as they accrued. It will not be right if the gains accrued at a different pattern than the constant rate of return, which will be true for many entrepreneurs who will have a very big gain early on once the thing goes public. It will not be the right formula if people are in different tax brackets in different years, which could happen over a long period of time. You have to deal with other issues like dividends. Somebody might try to pay an extraordinary dividend as opposed to realizing a capital gain because dividends wouldn't be subject to the look-back rule, so you'd have to have a special rule for that. I guess the point is you can do it, but it wouldn't necessarily give you an accurate answer. And in all cases, I think what troubled us about it, and you can make the economist's argument that it shouldn't be troubling, but people would be paying tax on an amount of gain which is much greater than the actual amount of gain they realized. And I think it's going to be very hard to explain to people that that's fair. I understand it's a repayment for the deferral benefit they got, so I'm not arguing with the economics, but.
All right, this question came up in the Q&A earlier, but I want to highlight it. Let's say Warren Buffett has $50 billion in stocks, and let's say the tax on mark-to-market is 40%, just round number instead of 37. So we get a recession, the market falls by 10%, Buffett's market value goes down by $5 billion, At a 40% rate, the government owes him $2 billion in a recession. I mean, in terms of, you might say, well, that's stimulus, but he's not going to spend any of it. And it's going to the wrong people. And it's the government writing a check to Warren Buffett for $2 billion while people are losing their jobs. Is this, I know we're economists, not politicians, but we regularly veer into the optics of policies. And am I getting the optics right here, or are there a way to change the optics? Or
Well,
what do
you
think
could
about that?
decide, you could decide for, unless you're going to apply the same rate to ordinary income, you don't want to allow capital losses in full against ordinary income, or we only allow them partially. But if you were worried about that or how it would look, you could do a carry forward, a carry back, and then if Warren Buffett's, most of his money is in the appreciation of assets, he doesn't realize he's not going to have enough ordinary income to absorb $2 billion, and we don't give refunds except for very rare cases to anybody.
I think, Bill, we were worried about the other problem. Bill Gale got a capital gain in 2020 at the end of the year of $5,000.
I like this already.
Right. And then, right after the end of the year, the stock market crashed. So he's filling out his tax return, and his value has gone down, and we're telling Bill, you got to pay tax on this $5,000. He's not going to be too happy. So our solution, it's not a perfect solution, was we would have only taken 20% of the gains into income in every year, and the other 80% would be carried forward. So, and that would do the same for losses. So we were trying to have some kind of smoothing mechanism. I think the volatility would be a very serious problem in a mark-to-market. And we have one solution. I think there might be others, but we do have to deal with that on both ends, on the gain and the loss end.
Personally and professionally, I admire your wisdom there. Carl, did you want to say something?
It's clear that if you're actually trying to measure income and people have losses, then they should take their losses into account. And as you said, for economists, that's not controversial, but we don't rule the world, right? I mean,
Hardly.
Representative Schakowsky was saying, experts can make all kinds of recommendations, but you have to deal with the politicians who've got to sell to their constituents that it's entirely appropriate to cut Warren Buffett a check for $2 billion just as revenues to the federal treasury are going down. But the same argument that gets you to wanting to tax the $5 billion of gain when the market goes up 10% leads you to giving him a refund on the decline in value. And one of the reasons why we don't allow that now is the selectivity, so that you can realize your gains and losses when you want, and the rate differential. Presumably in the world that is being considered in these proposals, both of those things go away. And so you probably need to think about getting rid of the $3,000 capital loss limitation that's in present law, unless you have an exemption that leaves people in the realization-based system, in which case you need to preserve it, and then you have to worry about people going in and out. Now, Warren Buffett probably doesn't need to be worried about flipping in and out of a realization system at any threshold that would be considered, but that's going to be an additional issue for concern about when you have losses in one regime or the other.
Great. So we've got this very complicated system of capital taxation right now. We've got corporate, non-corporate entities. We've got tax-deferred saving vehicles versus taxable saving vehicles. We've got municipal bonds, which are federal tax-free. Would mark-to-market apply to everything that's marketable? Retirement assets, municipal bonds, et cetera. Should it carve out the traditionally preferred parts, or is the problem that wealth is a traditionally preferred part of the tax system? How would you deal with that?
I would think you'd want to leave out retirement assets like you do now. They already got a different tax regime. And then the idea behind this system, I think, is to only apply it to rich people. So you would need some sort of exemption to keep. You don't want your ordinary person having to deal with this. I've thought a lot about how you do an exemption, and I would be inclined to the model of the estate and gift tax, where you have an annual exclusion to keep the little people out, and I'm actually one of those little people, and then a lifetime exclusion to deal with people with modest amounts of assets that they sell. So I think you would carve out assets of everybody but the rich, and you would probably carve out the retirement assets, I imagine.
You would do it based on someone's asset level or someone's capital gain?
Realizations, unrealized gains. I do an
Unrealized.
exemption based on your unrealized gains.
So let's say that's 5 million. Like anyone with unrealized gains under 5 million
I
in a
think that's
particular
little-
year.
I think that's a little high.
Okay,
but
pick a number, $1 million.
A million,
Okay,
maybe a
so-
million, or
okay.
$1.5 million, something like the exemption we had
Okay.
for the estate tax, and then an annual exemption, maybe 15,000.
All right, so someone has unrealized gains in a particular year of $1 million. Then going forward, the taxes on their unrealized gains above $1 million.
Right, unless you have an annual exemption too.
Right, okay.
Yeah. I think that, nothing is perfect. I mean, it's like Eric said, this formula is not perfect, but you can't have perfection in the tax code without leading to incredible complexity. So sometimes simple formulas, we adopted a lot of formulas in the Tax Cut and Jobs Act that I think probably made a lot of sense in a lot of ways, so.
I think if you're going to have if you don't have any exemptions, the ability of a mark-to-market system to greatly simplify the tax code is pretty significant. You can get rid of the 121 exclusions on your sale of your principal residence. You can get rid of the capital loss limitations. You can get rid of all of the things that police the capital ordinary divide if you equalize rates, as was done in '86. But I think people don't believe that that system would hold, even probably through the signing of a bill, right? And so the equalization of rates in '86 did last for a few years, but all of the architecture to preserve those distinctions was maintained because I think there was a recognition that it would not hold, and in fact was 4 years later and undid all of that, right? I think you have that problem in spades in this arena because you're going to have what are viewed to the same impetus that's motivating the desire to go after this type of income for high-income people is going to want to shield people who don't fit in whatever person's category is that to whom it should not apply, and that's probably somebody who's just a little bit richer than I am, right? Whenever you're talking to anybody about who should be out or who should be in, right?
Right.
They should all be richer than I
They
am.
should all be richer than I am.
Right.
And if you do that, I think you have a lot more difficulty with respect to the administration of any of these proposals. I do think that if you're thinking about this as a way of capturing all of this income from all these high-income people, whether you even have an estate tax anymore, I think is something that you could potentially have as a simplification for the proposal. Because one of the justifications for the estate tax is that it's a backstop to the income tax because there's all of this untaxed depreciation that is held at death because you have an exemption for capital gains at death and step up and those kinds of things that hasn't been taxed all along the way. If you have a regime like this, which is pretty broad in its application, that sort of justification goes away, and there's at least some simplification still on the table from eliminating that.
Yeah, I just want to make an additional comment about exemptions. If you look at this tax with no exemption, and I believe for administrative reasons you do want an exemption, a modest exemption, but if you had no exemptions, this tax would be extremely progressive because of the way capital gains are distributed, and the vast majority would be paid by the highest income people. If you want to have a small exemption, $1,000, a couple of $1,000, I think we made an estimate that if you exempted $1,000, you'd take about 90% of the people out of the regime every year at a cost of maybe losing 3% of the revenue. So it wouldn't be, maybe you want a bigger number. I think Jane has a bigger number that we hadn't involved. But I think if you try to get a regime where you exempt the upper middle class or you have only want to apply this to people with income over $1 million, and you still want to maintain a realization-based tax with the upper middle class, you don't want to eliminate capital gains, it gets extremely complicated very fast. I mean, I'd like the legal panel to maybe discuss Senator Wyden's proposal, because I can't really figure out how to make it work, but maybe Jane can. So I think this is a real issue that you need to think about in all of these things, and particularly for a tax where you're treating one kind of capital gains one way for some people, a different way for other people, maybe exempt for a third group of people. And then you have to kind of ask yourself, how much is it worth it to have the talking point that no one under except very rich people pay this? Because anything you do, the majority will be paid by very rich people.
You're not sounding like someone who made a proposal that we move in this direction a few years ago.
Well, no, I mean, our proposal admittedly would not have only applied to very rich people.
Okay.
But it would have been extremely progressive.
Right.
So that's not,
Okay. On the theme of
we're okay with that.
Okay.
Yeah.
Okay.
Yeah.
On the theme of complicated, let's come back to the estate tax issue that Carl mentioned. Essentially, a mark-to-market system would tax accruals going forward, but it wouldn't do anything to the currently accumulated accruals. So I was thinking of the state tax and a market-to-market system as a way of getting at the previously accrued gains that were never subject to tax. But maybe, let me just ask Jane or Eric or Carl to comment on that. It seems like if we want to go after grandfathered gains, grandfathered assets, that we would still need something like an estate tax or a wealth tax.
Well, I think you'd want to, I mean, I think the easiest idea is to kind of fit into the system we got already, which is the estate tax. You do have to value assets that aren't sold. So this, you treat death as a realization event so that people would then have to do this look-back method at that point. Now, there you have a potentially serious liquidity problem, but we've dealt with liquidity problems in the estate tax before. If you have an adequate exemption, you're only talking about rich people. You could have, one idea is to have just an extended payment period that you pay back with interest. People should prepare with their estates to be able to pay taxes by getting insurance and things like that. So I don't think that's that liquidity issue is really insurmountable because you do have assets, presumably have some value that's enough to pay that tax.
Right.
Yeah, I think what we had proposed for the publicly traded assets was really similar to what was enacted in TCJA in the international regime for wealth held overseas. That is a lump sum tax on the accrued gains, and you would have valuation, but you'd have valuation every year anyway. That's part of the proposal. So if you can value them, then you would basically report your accrued capital gains on the effective date, and you would pay tax at a much reduced rate on those gains. And we'd let people pay them over 10 years to ease the liquidity problem.
I mean, I think the transition issues are just a design feature, right? You've got to decide what you're going to do in any regime that's going to mark to market about accrued and unrealized gains on the date of enactment. Right. And one could go in different ways about how to implement that. I think if you were trying to think about ways of simplifying the system, you could make different choices about how you would implement a transition tax on the movement to this regime. I think you do have to have some concern about leaning on the estate tax architecture. I mean, there are valuation discounts and things which are not the most administrable, and sort of, if one were designing a system in the absence of some of the considerations there, you would not write the rules that we have. You might think about how much of those rules you would want to bleed into this system, or at least as the Joint Committee on Taxation would think about scoring these provisions, would presumably assume that some of those same options that are available to reduce the value of estates would be available to reduce the value of the annual mark-to-market gain property as well. So I think while some of the features that Jane was talking about in terms of an annual gift-type exclusion with a lifetime exemption, maybe you would import into this regime, but you want to think carefully about how much of that regime you'd want to import. Mm-hmm.
Yeah, I would like to add, if this, when you're thinking about these assets, I would consider adopting the legislation that was proposed to eliminate minority discounts for this purpose and maybe for the estate tax in general, because that's really it's a trick, and the most important trick of reducing estate tax.
I should know this, but I don't. Has any country or state or entity implemented mark-to-market? Like, is there a system somewhere around the world that we can copy Or is this?
I mean, there are limited examples in the U.S. federal tax
Right.
system already, right? So there's for certain traders and assets, and dealers, they have a mark-to-market regime. Some people have proposed in the past making that regime elective for any taxpayer that would want to get into the system. You could build on the system by just making that system mandatory. There have other proposals with respect to specific contracts that have been in the law for almost 40 years with respect to certain derivative contracts for which you have to post margin, and therefore some of the valuation concerns and liquidity concerns have been addressed. And so we do it in limited ways in the U.S. There are a few other regimes around the world that impute, I think, for various purposes, those kinds of rules. One way, there are some, that example that systems that deal with imputed rent is one way about taxing wealth and sort of income from assets on a mark-to-market basis, though it's not the one we usually think about in this context, but there are a few countries that do that.
Yeah, I think we also have our PFIC rules. I don't know if you want to comment on that, Carl, but that is very complicated, but I think it does have a mark-to-market option that taxpayers could use.
But it's applied in extremely technical, but financial situations.
Well, this was with passive foreign investment companies where there's really no way to get that income without some regime like that.
Yeah.
And then with respect to expatriates, they have a mark-to-market exit tax when they give up their U.S. citizenship. And so that has
The exit tax, yes.
Yeah.
Interesting, okay. Good, and how much revenue are we talking about? Suppose we went to mark-to-market and taxed at the ordinary income tax rate, and presumably we would raise the realized capital gain rate to match that.
So I kind of did an estimate in my paper looking at the estimate of accrued gains relative to realized gains that exist, which is about the same size, and came up with an annual revenue gain at current tax rates of $180 billion. Now, that could be off by a lot, but that's the kind of general magnitude of the revenue you'd expect from the system. It might, if you have grandfathering, it might take a while for this to occur. There would be a lag the look-back method would mean the revenue would probably rise over time, but that's kind of a steady state annual revenue. You get more if you raised, then you would be able to raise the capital gains tax rate without running the realizations response, so you could raise probably a lot more revenue if you raised rates, and I think I came up with about $225 billion or something if you also raised rates to ordinary levels. It's a lot of money potentially involved.
Well, it's the same order of magnitude as the 2%, 3% wealth tax, right? I'm not sure about the 6%.
Well, I think there
Well,
are.
the wealth tax, to be sure, has a very big exemption.
Yeah.
So
This is
it's
without
no
exemptions,
difference,
Sorry,
right, that's right.
I was referring to the original Warren proposal.
Right.
Yeah, now if you're going to have an exemption for retirement assets, that's going to take a huge chunk of the money out of that proposal. I think
don't think-
unless it
I
was
think
in
the
yours.
assumption that we've
No,
all made is you would exempt retirement.
Yeah, my
assets.
estimate assumes those
Assumes
are
that.
exempted. Yeah.
If you look at the holdings of corporate stock, only about a third are held by taxable people today. Somewhere between a quarter and a third. I know that there are different estimates out there on that. But I think
My estimate took account of that
yeah,
too.
one of the reasons why you think about moving to a regime like this is because of concerns about whether you can raise revenue from other sources. So the revenue maximizing rate on ordinary income is affected by the ability to transfer ordinary income into capital gain income. And if you take into account the effect not just on the federal income tax base, but on federal payroll tax base and the state income tax bases, we're actually pretty close to the revenue maximizing rate on ordinary income today. Given what JCT and others assume about the ability to deal with realization, we're pretty close to the revenue maximizing rate on capital gains as well at the federal level. And so by dealing with realization, you do alter those elasticities that affect those revenue maximizing rates, and presumably that's part of what is at stake here. So people are trying to alter those parameters that derive those revenue possibilities today. Whether you'd be able to get up to those levels, I think, is certainly an open question. I think in looking at the distribution of wealth, I think I would caution people about taking the estimates that Saez and Zuckman have put together for both the Warren and the Sanders campaign about the holdings of wealth. If you saw some of the commentary by Larry Summers, who is, no right-wing nut about any of this, he said that he's been 98.5% convinced by their critics that there are severe concerns about their methodology and about how much wealth is at the top. And so the levels of thresholds and exemptions that you're talking about are going to greatly influence where you think the revenue possibilities from a proposal like this or from the wealth taxes to which it will be compared really lie.
Before we go to that comparison, let me just ask you if you have seen or thought about or have any sense about what the macro effects would be of adding mark-to-market to the tax system.
I would say they're probably pretty small. I mean, you increase the return to people, you decrease the return to savings, but I really think there's just powerful evidence that the savings response is very modest. Now, you might reduce savings because you're taking money away from people who are savers. But of course, at the same time that you may be reducing private savings, you'd be increasing national government savings, so that would be kind of a wash. So I really don't think there'll be any important. We just wrote a paper that perhaps some of y'all saw about the effects of the Tax Cuts and Jobs Act on the economy in the first year, and it was just very hard to find any evidence that it had much effect on real activity, whether wages or output or even investment. So I just think the notion that there's a big behavioral response to taxing the wealthy, I just don't think the evidence is there, but I haven't thought that in a long time.
I think you do want to think about a mark-to-market regime and estate tax and capital gains taxation is all sort of the same thing with a slightly different legal rate. They're all taxes on capital. Mm-hmm. And so if you are going to change the rate of tax on capital, and presumably these are increase both the statutory rates, but the real rates that apply to that kind of income, you would expect there to be some effects on capital supply, and whether that has an effect on investment is going to depend on a lot of channels through which that might operate. But there are two effects. I mean, the one effect to which Jane alluded is that there's an income effect. I mean, if you're going to tell me that you're going to take $2 trillion out of the economy and nobody's going to do anything, I think you're ignoring the fact that you made somebody $2 trillion poorer. And whether you have any sympathy for them or not is a separate matter about whether or not that affects their consumption, their investment, their savings opportunities, their asset holdings. So do they purchase, different amounts of assets that may be in or out, and so does that change the government's borrowing rate, for example? If treasuries are a significant part of that, depending on the form of the capital tax, that matters a lot, given relatively low rates of return on treasuries right now. It matters less in a mark-to-market regime than it does in a wealth tax regime. But I think in addition to those income effects, you're going to concern about the price effects, that there are going to be changes in the price of capital, the return to savings. And I imagine that not only will folks on this panel disagree about how sensitive that investment is to those changes in the savings rates, I imagine that those who are estimating these proposals on the Hill also have varied views about that. And they would presumably be reflected in a macro statement by the Joint Committee. A bill of the one that we're talking about here would be a significant size that I would imagine there would be a request for such an analysis.
Just a couple of comments in the context of the global economy in which we find ourselves. All these taxes, whether they be wealth taxes or accrued capital gains, are taxes on American residents, and they fall on American savers the same whether their saving is overseas or at home. So they, as a first approximation, they're not driving capital out of the United States. They are reducing wealth of high-income individuals, which I think, even if there's no elasticity, there's going to be some reduction in saving because much of that is saved. And if that money is used to finance new spending programs, it may lead to a net reduction in national saving. That could affect investment through several channels. I mean, the saving for investment could come in from overseas. It could be coming in through an increase in saving or an increase in returns for people who are not subject to these taxes. So there are various channels for which the reduction in capital could be mitigated. So I don't have a notion of the magnitude. I have an idea of the direction. There probably would be some reduction in investment.
All right. So I don't want to take us too far afield from mark-to-market, but I do want to frame mark-to-market in the broader context of taxing the rich. All right. And so let's accept for discussion purposes the idea that we want to increase taxes on the well-to-do, whether it's high income or high wealth households. How does mark-to-market, in your mind, compare to the other major options?
Well, I would say with respect to the one that occurs immediately, the wealth tax, it seems to me this is an easier system. It's embedded in our system we already have. It's easy to develop some simplified formulas for dealing with untraded assets. And a wealth tax, you would have to do valuations. And it just seems to me that would be, that would not occur. There would be no more valuations under the system that of taxing capital gains. But with a wealth tax, you would have to have annual. I mean, otherwise, a wealth tax is a very good way of getting at wealthy people, obviously. But I think there are administrative problems that create a difference. I mean, the simplest way to tax the wealthy and to gain revenue for other purposes is probably to increase the corporate income tax, which is implicitly taxing the gains to holdings of corporate stock, or to eliminate the pass-through deduction for high income. And there are a lot of little things you could do that would be simpler. So it all depends on how you're trading off getting at your target with some administrative costs versus keeping things as simple as possible. We've always got that. Often it seems that simplicity loses when we do tax reform, but I think that's one of the trade-offs that we're having here.
Before you guys address this question, I want to follow up on this. First, it's always the case that simplicity loses, not often.
That's really true.
Well, in part because people don't like it, right?
They said when we talk about mark-to-market, we say, well, we would do it for marketable assets and we would have some look-back procedure for non-marketable assets. But then when you talked about the wealth tax, you said, well, we'd have to tax all wealth and we can't tax wealth that's not in the market. So why couldn't you have a wealth tax that applied to marketable assets and a look-back wealth tax that calculated the wealth tax that people would have paid that applies when they sell the assets?
When they sell, yeah, I guess you could do that. I guess that would I haven't thought
Might
about
be greater
that,
than
so
100%.
I have to run that through my computer
Yeah.
here, but I think that's an interesting idea. I'll give it some thought. That seems to have some possibilities.
I just had one other concern that I wanted to raise about our current system. And when we did our proposal, we were talking about reducing the corporate tax rate and very significantly, and then applying this mark-to-market regime for shares. And we weren't applying the mark-to-market regime to privately held or non-tradable companies. In order to make that work, we had to have a rule that said you could not be a corporation if you were not publicly traded. You could not be taxed as a corporation. You'd have to be subject to a full integration regime. And I think we might have to think about that in this system. Yeah. We have a 21% top corporate rate, which maybe is justified in terms of global competition, but makes absolutely no sense for small privately held companies or for private equity. And I think that's really a big hole in the system, because that's where a lot of the wealth is accrued.
I mean, on simplicity, I'll say, we had a huge increase in the standard deduction, which was greatly simplifying for a lot of people, particularly when it was combined with the limitation on state and local tax deductions. And you can see that that was not hugely popular by a lot of the people who benefited, in quotes, from that simplification. And if you think about, a tax on high-income individuals, actually, if you made the SALT limitation permanent, that would raise, I think, even more as a percentage of the revenue from high-income folks than a tax on mark-to-market gains would be, because I think those deductions under present law are more highly concentrated at the top even than capital income is. If you look at the tables that the Joint Committee put out in their pamphlet on the hearing that was held in the House on that proposal, I think you can see that. So there are some other things that could be done. I think if you were concerned about high income, now the question is that in this discussion, we're not thinking about high income in a way that includes most of the people in this room. And so that would be a difference from some of those other proposals that are out there. I think if you're looking at the wealth components, one additional feature to think about those is even if you believe that the constitutional questions are easily resolved, I don't believe that they are quickly resolved, that you at least have to work through the court system. And if you're talking about in the near term, that's going to delay the income to the U.S. Treasury by at least as long as it takes to litigate those questions. And so if you're thinking about using the funding from a proposal like this to start benefits that begin immediately, you might want to have a revenue source that also begins immediately. And I think you would be in a little bit better position building on something like mark-to-market gains in the current income tax system than from some of the novel proposals that are out there today.
That's really interesting. We will leave the constitutionality of the wealth tax to the legal panel.
I don't mean to opine on that at all, just other than to say the timing issue I think is real.
Right,
So.
right. So we had a quid pro quo when we set up this session, which was no opening statements, but I would ask people at the end if they wanted to add additional comments or if there's anything that, we want no comment left unsaid. So what are your perspectives or additional points, anything we missed?
Well, if I were thinking about trying to tax high-income people, I would start with the simplest proposals that are already embedded in the tax system. I think I mentioned some of them: taxing carried interest, taxing the net investment income tax on unincorporated businesses, eliminating the pass-through deduction for high-income people, raising the corporate rate. Those are the easy things to do. But I do think a mark-to-market system is feasible. It's feasible to do probably quickly. I don't think it'll have the problems Carl raised. And I think if you want to tax the income of really, really wealthy people, their income is almost all accrued capital gains. The one thing that we have not talked about in this panel and that would leave to another time is the effect on charitable deductions. You need to think about that always and any time you're changing taxes. But I do think I think it's possible to do this. I really do think it's possible to design a system that will be workable for taxing unrealized capital gains. So that's my big point.
Yeah, on charities, one of the proposals that's always been out there is to, on gifts of appreciated property to charitable organizations, only limiting the deduction to basis rather than to the fair market value. Yeah. I suppose the folks at the Tax Policy Center and the Brookings Institution may have thoughts on whether they think that's a fantastic idea for taxing high-income people, but it is certainly treating that as a realization may be another smaller component of this. I think in thinking about things that we haven't really talked about too much to this point, we alluded to some of the discussions we had privately in advance of this session on what happens to depreciation. I think those issues are actually really important. If you're going to mark all assets, that means you're going to mark assets that include things like capital assets used in a trade or business. And I think if you were to include all of them, you can probably repeal all of the depreciation rules that are in existence, because depreciation is about measuring the change in market value of assets. If you actually could measure that, you wouldn't need any of those systems. However, if you do that, you're probably undoing any congressional incentive to accelerate depreciation to encourage investment in those assets. So whether that's accelerated depreciation under makers, or whether it's full expensing that we have on a temporary basis, or other accelerated cost recovery for research and experimentation expenditures, all of those things are implicated, I think, in a world in which you had a truly universal mark-to-market system. And I think those issues are not trivial to address and to think about. And so for those who are trying to work about a policy that you would implement that would cover these things, I think they deserve a good deal of attention, and to consider the trade-offs in those other non-revenue policies with respect to investment.
That's really good.
Okay, I just have 2 points, and they're very general. One is we've considered a lot of options. There are a lot of options we haven't considered very carefully. Every option you can think of has its strengths and weaknesses. Everything leads to some avoidance, but in different ways and on different margins. And my view is, given that situation, we probably should do a little bit of everything, rather than trying to say one particular method is the best. And the other point I would make is that high-income people are very resourceful. They're very well advised. They will find ways to avoid anything that we do. It doesn't mean that we shouldn't do these things, but it does mean we shouldn't overemphasize or overthink what we can pay for with these things. That this may not be enough.
That's very interesting. All right, thank you. Let's turn to questions. We have a mic. Yeah. This gentleman all the way up in front.
Hi, Frank Clementi, Americans for Tax Fairness. I just back on the transition question, the transition rule question. So I think someone's saying, well, you could take care of it with the estate tax, strengthening the estate tax, hopefully. Others said, well, maybe you do the transition tax. Seems to me that transition tax, you get the money right up front. Well, or perhaps a 5 or 10 year slide, as Eric was proposing. I'm just, we had the 15% rate on corporate repatriation. So let's say we did a transition rule. What would your ideal transition rule be? What would the rate be at, and the period of time? Would it be like the current capital gains rate with the NIT involved, 23.8% over 5 or 10 years, or what? It's folks who I've talked to said, well, you'll never get a transition tax like this. It's too unprecedented. If they could do it on the corporate side, why can't we do it on the individual side?
Well, I would say for the look-back method, you just go all the way back to whenever you acquired the asset. And for mark-to-market, I think Eric's idea of taxing it over a period of time, although I would extend it over a period of time, and I probably wouldn't have a lower rate. I'd probably have the same rate that you have with ordinary capital gains. But there's a lot of different ways that you can do it. I think the repatriation tax is one model, but I think a lot of different ways to do it. I just have to decide what you want to do about it.
I think if you did have something, the one thing you'd have is you'd have an 8-year payment rule. That way all the money ends up in the window for the budget scorekeeping purposes. It would not be 10 years.
Right. Good.
I think also you have to consider there are 2 transitions involved. There's a transition for people owning stocks who are coming into the system. Mm-hmm. There's also ongoing going to be transitions for people, entrepreneurs who start companies and want to go public, and then after they go public will move into the mark-to-market system. So you want to make sure that the transition tax that's imposed on them that when they do that is not so onerous that they will be discouraged from doing that. So that's another problem you have to consider.
All right, great. Right here.
Ben Clemens, U.S. Treasury. Not all publicly traded assets have all that much liquidity. A blue chip stock may trade, 10 times a second, but an option on a blue chip stock to buy in February of 2021 at $112.14, that may trade once. Right? So for that valuation, our sort of the immediate answer would be mark to theory. Right, there's a Black-Scholes model. We can mark that. Does that sort of thing sound reasonable to you for infrequently traded assets? Are there alternatives? Would that generalize to other sorts of infrequently traded assets?
So I think with respect to
assets?
derivatives, most of those are short duration, and so some folks who've thought about this in the past have said if you get the valuation wrong the first time you mark, the thing's going to expire the second time you mark, and so it'll be self-correcting. And so if you really do have an asset like that that is of short duration, the problem is much less important than if it is a marketable security that doesn't, for whom those characteristics are not true. I think for the universe of things that you're talking about, they probably more look like the short duration derivatives than other kinds of issues, and so I don't know how much of a concern that would be relative to all of the other valuation concerns that you also have in the system to begin with.
Though even at short term, there's some point where you have to write down.
Mike,
Yeah.
please use the mic. Oh.
Yeah, you still have to come up with a number, and that's true for any asset subject to the regime. And if you have a mark-to-model regime rather than a mark-to-market regime, but at some point there is a realization event for which the true value is known, and as long as that's short in time, it is not a terribly administrative issue, I think, compared to the other administrative issues that you have in the regime to begin with.
Thanks. Josh, we're over halfway back.
Thank you. My name is Albert Deal. I'm president of Deal Global Associates. The focus on the panel has been how to raise more money to pay for government expenditures. We start today with raising $4.5 trillion and spending $5.5. So the only estimate of what might occur is, James, you said 980 billion. We need at least another trillion to get to a balanced budget. And has the Congressional Budget Office or the Joint Taxation Committee looked at the impact of the proposals that are on both sides of the aisle, presidential candidates, health care for all, free tuition? How much do you need to raise in order to make financial sense?
Well, I could just say that I think there's a limit to how much you can raise from high-income people. So if you all want really broad, massive changes, I doubt there's a way you can avoid going beyond that group of wealthy people. But I don't have the numbers in my head, but we do have limits on how much, because this is the people we're talking about is a small part, large part of wealth, but a small part of the population.
Now, let me just add to that. One of the interesting things about this discussion in the broader public dimension is that we're actually talking about tax increases. And we're actually doing it during an election, which is doubly astonishing. And it's triply astonishing given that there's easy out that the liberals senators can take, which is to say we believe in modern monetary theory. And so
I wrote a paper on that.
we're not going to worry about paying for this. So to me, it's remarkable that, for all those reasons, that this is actually on the table right now. We're talking about all these very big options, wealth tax, mark-to-market, whatever, to finance either new government spending or the existing federal debt. So there are numbers about how much we need to raise, but I don't know, I can talk to you later about it, but it's a lot of money. Josh.
Thank you. Can the panel address the issue of whether, if the U.S. takes moves like this, but other advanced economies don't, how they would anticipate this to affect capital flows, investment, and I guess the relative attractiveness of investing in the U.S. versus somewhere else over time?
Well, since it's a tax on the savings side, as Eric said earlier, it doesn't matter where you make your investments when you pay this tax. It's actually for international capital flow issues or location. It's better to have a tax on the savings side. Now, I'm not a believer that capital flows that easily across countries anyway, so I don't really worry about any of this. I spend a lot more time worrying about our growing and horrific debt But I don't think that is an issue, and I think we might have to worry about rich people trying to leave the country to avoid the tax, and so I think we would need some sort of exit tax to make sure that we tax the wealth, and we would have to might strengthen some of our rules on corporate inversions, and we've already pretty much enacted at least a temporary, powerful preventive provision in the Tax Cuts and Jobs Act, but we might want to think about tightening that up. But these are all things we can do something about.
All males. Yes, sir.
Thanks. I guess I get two questions. Carl Polzer. I just want to ask a measurement question. So don't we need to be really clear when we're taxing the gain, whether it's nominal dollars or real dollars? And this goes to a problem in the current system. In other words, right now we're in a period of low inflation, but we won't always be. And even now, if your inflation's higher than your gain, you'd be paying taxes on a loss.
All right, so first question is, should we index? What?
Yeah,
okay.
Okay. Well, that's my question.
Right. What do you think?
Well, I think indexing would be nice, but I think we ought to think about indexing everything and trying to get everything right. And right now we don't index. As long as we don't index interest, then we have a real problem with indexing capital gains. So deductions for interest. So I think you'd have to, if you want to think about indexing, I think you have to think much broader than capital gains. It is complicated. If you kept a lower rate for capital gains, I think the case is much for doing indexing is less. So it just depends, again, on how you want to trade off dealing with that indexing issue versus more simple things like accelerated depreciation and limits on interest deductions and things like that.
Yeah, I mean, the Treasury One study in 1984 looked at some of these issues, and I mean, they've not gotten any less thorny in the intervening years. But if you do think about trying to take into account the effects of real versus nominal income across the tax system, there are a lot of places where you need to look. Now, if you're talking about, this is just income, we're putting in the rate bracket structure, and the rate brackets are indexed for inflation, you're getting something on that dimension that is arguably not there in the current taxation of gains in the same kind of way. But that's certainly not sufficient to address the main issue if you were going to do it. And you'd want to do it on the interest, both deduction and on the income side. And if you start going down that road, it's tractable, but that's a significant amount of work that would need to be done in order to get that even close to right. And if you do say, throw up your hands, and so we'll keep a lower rate as a partial justification for not dealing with the inflation indexing, then all of the simplification we thought were by limiting the loss offset rules and things like that come back in, and you just have to ask, well, would you rather have that those issues or the issues of dealing with indexing?
All right, one last question, way in the back.
Thank you. Dave Rabinowitz. It was mentioned earlier that during the 1950s, the maximum tax rate was over 90%. And at that time, there were more than 20 tax brackets. I'm wondering why and that's also how we financed the last major infrastructure project, the federal highway system, interstate. But I'm wondering why we couldn't simply just consider capital gains and dividends as ordinary income, increase the number of brackets, and increase the tax rates to accomplish everything you're talking about.
Well, just as a factual matter, in the 1950s, when the top rate was 90%, the top capital gains rate was only 25%. So there was a big incentive then, a big escape hole for people in terms of converting income to capital gains. So the system was not quite as tight or as harsh on the rich in the 1950s as it somehow made out to be.
Yeah. And how much you can raise rates and get revenue out of that depends critically on what the base is, on how broad the base is. So the old philosophy used to be broaden the base and lower the rates to get you a flatter, more efficient tax system. The new thinking is sort of still broaden the base, but once you've done that, you've reduced the elasticity, the ability of people to avoid the tax. If you literally taxed everything, you couldn't avoid the tax. So the argument is do that first and then raise the rate to collect revenue from high-income households. And that's sort of, in my view, a kind of big a sea change in the way economists are talking about tax policy. So it's a great question. It's a great question to end the session on. And let me thank all my panelists for excellent discussion.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.